Hello and welcome to Sustainable Finance, a Transatlantic Dialogue brought to you by Time. My name is Camilla Macpherson. I'm Head of Secretariat for Prime Finance, and I'm going to start with some housekeeping. So first, just to let you know that the session is being recorded and will be distributed later. Attendees are muted and have their videos switched off. We'd love to hear from you if you've got a comment or question. Please use the Q&A function on Zoom to do that. In the meantime, we'll be contacting you using the chat function throughout the course of this session. I'd like to thank Dwarf Financial Technologies and FTI Consulting for sponsoring this series of Prime Time, and Channel Capital for sponsoring this particular session. Thank you also to LexisNexis for helping with promotion of Prime Time. Let me now introduce our speakers for the day. Dame Elizabeth Corley is Chair of the Impact Investing Institute and is also a non-executive director of a range of FTSE and S&P 100 companies. Elizabeth has extensive experience in the financial services industry, having been CEO of Allianz Global Investors, initially for Europe, then globally from 2005 to 2016. Elizabeth is active in representing the investment industry and developing standards within it. Her other activities include being a director of the Green Finance Institute, a trustee of the British Museum, and a member of the 300 Group of Investors and of C200, an international community of leading business women. Eric Pan is President and Chief Executive Officer of the Investment Company Institute, the leading association representing funds globally. Eric was previously a Managing Director of Rock Creek Global Advisors and a Senior Research Fellow at the Center for Law and Economic Studies at Columbia Law School in New York. He previously served as the Director of the Office of International Affairs at the US Commodity Futures Trading Commission and Head of International Regulatory Policy at the US Securities and Exchange Commission. He's also a prime finance expert. Finally, Ida Levine, who's moderating today's session. She's Principal of Two Rivers Associates in London. She's on the board of the Impact Investing Institute and Investor Forum. She's a member of the Financial Markets Law Committee and chair of the Securities Regulation Committee of the International Law Association. She's a former board director, senior VP and senior counsel at Capital Group America Funds. She's a former European counsel at JP Morgan Investment Management, a former partner of Jones Day, and she sits on the management board of Prime Finance, as well as being a prime finance expert. I'll now pass over to Ida to introduce today's session.
Thank you very much, Camilla, and greetings to our international audience. We are really grateful that you have joined us, and you're in for a fascinating discussion with our distinguished panelists. Sustainable finance is one of the hottest topics in the financial services industry. Traditionally, investors made investment decisions based solely on financial factors with the goal of maximizing risk-adjusted financial returns. But times have changed. Over the last few years, an increasing number of institutional investors and retail savers in Europe, the US, and Asia are making decisions with an eye to sustainability and material ESG factors as part of their investment process. The growth in sustainable investing assets globally is staggering. According to data from the leading publication, Pensions and Investments, the value of global assets applying ESG data to drive investment decisions has almost doubled over 4 years and more than tripled over 8 years to $40.5 trillion in 2020. Not only has ESG investing been adopted by investors, sustainable finance has become a pillar of economic policy in the EU and UK, with other jurisdictions beginning to follow suit. The EU, with the UK as a member, has been a thought leader in this area. With Brexit, the UK will be following a separate path, but early signs are that it will seek to be equally ambitious. And President Biden's administration in the US also appears to be prioritizing climate and ESG. At the beginning of the COVID-19 pandemic, there were questions about whether the focus on climate change and sustainable finance would endure. But the pandemic seems to have reinforced the public's appetite for ESG investing and placed a new emphasis on the S next to the E. The new mantra is Build Back Better. But do consumers know what they're getting? Is there clear differentiation? And do products and services deliver on their promise of both a financial return and benefits for people and planet? And will these investments bring in a new era of sustainable finance and fulfill the objectives of policymakers and regulators? The truth is that the landscape is confusing and fragmented, with different approaches and conflicting terminology. There is a need for standard setters and regulators to step in to bring some clarity, both at a local and global level. Today, we'll start with a discussion of market and consumer developments. We'll move on to recent regulatory issues, and then on to challenges and risks. But save up your questions. Please use the Q&A function to send them, and we'll reserve 10 minutes at the end of the session for Q&A and endeavor to cover as many questions as possible. And now over to Elizabeth to set the stage with the spectrum of capital.
Thanks, Ida, and good morning, good afternoon, good evening, everybody. It's absolutely a pleasure to be with you here today with Ida and Eric, and we've got a lot to cover. As Ida said, there's a plethora of acronyms, initials, letters flying around to describe what's happening in the world of sustainable finance and ESG investing. So when we were thinking about this session, we thought we'd start with something which would frame our conversations. There are many definitions out there. We're not about to say this is the only one, but we thought it would be helpful to start differentiating between traditional investing right through to that which drives impact. So Camilla, if you could just bring up the only slide I promise you we're using today, which is the spectrum of capital. I hope everybody can see that. This was developed by the Impact Management Project and Bridges Foundation, and many of you on the call, I'm sure, are with firms that are associated with the Impact Management Project, which is a fantastic global initiative. Essentially, if you work across the spectrum, you've got an x-axis that goes from very traditional investing right through responsible to sustainable, and then thinking about impact. And the simple way to think about this is the ABC. As people move away from investing wherever they want to, driven purely by what they see in market data around risk and returns, the first thing people seek to do is to avoid risk, to identify and avoid risk. And this is particularly true as investors and owners of capital decide that there are things in the external environment that are not yet reflected in the data that the markets see. So that valuations could be over or understated, that risks could be non-present in the way in which information is disclosed. So that risk avoidance and mitigation, the A, is the starting point. And we've seen increasingly in the last 2 to 3 years, that's becoming mandatory in some jurisdictions. And if it's not mandatory, it's certainly demanded by many, many investors representing trillions of dollars. As people start to consider what isn't in the numbers already in the financial accounts and reports from companies, whether that's public or private, they then start to realize that there are opportunities out there that are also not priced into markets. And as we all know, markets are fantastic discounting mechanisms. And so people seek to identify those future opportunities. This is all with a finance first lens, always thinking about sustainable financial returns within a risk environment, within the risk framework companies have set themselves or their clients have mandated. So the B is around the benefits. It's around what is there out there that is an opportunity and an opportunity for us to create benefits. Think of it simply as alternative energy or renewable sources. But the benefits go beyond risk avoidance, and they seek to define ways in which we can start to address some of the planet's most dangerous and difficult challenges. Still with a finance first lens, Ida, people then think about contributing to the solutions. This might be in specific private investments around new technologies, innovation, R&D, venture capital, or it can be public listed companies who explicitly make a pledge for their products and services to contribute to solutions. Now, typically people start to talk about this in the context of the United Nations Sustainable Development Goals, but not always. So the C is around the contribution. As you work through this spectrum, there's an opportunity to dial down the financial requirements and dial up the impact. And when we talk about impact investing at the Impact Investing Institute, we use a definition that is common throughout the world, which is that you start with an intent to have an outcome, you're accountable for measuring it, and you report on it. So intention, accountability, and disclosure. So that's a simple spectrum that I hope will anchor some of our conversation today. So Camilla, we can take that down now. Thank you.
Thank you very much. I'm actually going to go to Eric next and ask what's happening in the US? How's the market developing? Is there more of an appetite for ESG?
Sure. So, well, first, thank you, Prime Finance, and it's a pleasure to share the stage with Elizabeth and Ida. It's a really important topic. So look, I think the United States is definitely, there's a lot of interest in ESG investing. In terms of asset management firms, they are creating new funds to try to meet this demand. Here at ICI, we noted that in 2020, there were about 90 new ESG criteria funds that were developed. And that represents about 16% of all new funds. So this is sizable growth in a new area. And we're looking at about $465 billion in these ESG criteria funds. So, it's a huge market and it's a growing market. And I think it's a reflection of changing investor preferences. I think it's also a reflection of the fact that the industry is trying to meet this demand. And there's no sign that this demand is going to decrease anytime soon. And especially as the regulatory environment, which I know we're going to get into in more detail later, but as the regulatory environment becomes clear, I think you're just going to see an increase in the space as well. I would just kind of note that one thing that funds are looking for is some type of mandatory disclosure from companies. Our members at the Investment Company Institute have called for disclosure in accordance with TCFD and the Sustainability Accounting Standards Board, and it's something I hope that we can talk about in more detail later. But this shows that it's a bit of a push and pull in that we're trying to meet demand, but at the same time, I think there's a hunger from investment managers and fund managers to try to define criteria, define common terminology, define common standards that would actually help them provide more of these opportunities.
Thank you. We only have a few more minutes for this section, but could Eric and Elizabeth quickly go through Asia, and then where's the UK and EU market? I think that's probably the most well-known, but starting with Asia.
So why don't I take on Asia? So I think Asia is following a similar pattern that we're seeing in the United States. So initially, if we call it kind of phase one, a lot of the initial ESG investing has come from kind of government-directed pension funds, which of course is a significant portion of kind of savings in Asia. But we're starting to see that this is now moving into individual preferences, especially kind of wealthier, upper middle class individuals who also have an interest in ESG investing. And so we're seeing this shift in the market out in Asia. And so I think that when you view it from a market perspective, Asia clearly is going to be a huge growth market for ESG investing. They're probably less advanced in terms of market development than the United States, but that's quickly going to change. And I know that, again, for international asset management firms, there's definitely an interest in trying to open up ESG investing opportunities out in Asia.
And Elizabeth, we've heard a lot about the UK and the EU, but what's the latest? What's the latest trend we're seeing?
Well, I mean, everybody knows the flows, that if you look at the net flows, they're all into ESG and sustainable finance products, even when other categories are in outflow. So there's absolutely no doubt that there is an enormous amount of capital in motion, enormous amount. And that is despite some fairly significant regulatory requirements, which we'll get into. That is driven by both institutional and individual demand. And there is no sign that that is abating in the least. If anything, it's growing. And particularly in the institutional world and the financial advisor world, people are becoming more sophisticated in trying to differentiate between good and bad. And I don't mean bad as in maliciously bad, but just not as in well developed. Just as we went through evolutions in the past on different types and styles of investing, so we're seeing that evolution in ESG investing, with more sophisticated and proven approaches starting to take significantly more flows as people become more thoughtful. So this is increasing. We're seeing thematic funds as well as broadly based across the spectrum funds. I would say green is still dominating in many respects, but then when we had the COVID pandemic and the situation around Black Lives Matter and the social justice movement, we've seen a combination of social factors. By that I mean caring about people as well as planet, combining with the green. And one of the things that's happening is people are starting to say, I want a green product, but I need to know it's doing no damage to people and it's benefiting communities. And therefore, the stakes are going up for people really delivering on that promise.
Thanks, Elizabeth. I'm going to move on to regulation. And I think it would be good to start with Europe and the UK and the key developments there, because they've been sort of ahead of the pack. And then maybe Eric could comment on the question everybody's asking, which is, what will the new administration do? So maybe start with Elizabeth, please.
Yeah, and I'd like to pick up on a theme that Eric raised around the Institute's requirements on companies to disclose, because there's no doubt that one of the major drivers is around corporate reporting and the disclosure of information. The Investment Association in the UK also requires their advice to government, to the Treasury in the UK, was that companies should disclose against TCFD and SASB. We've seen the announcement by the Group of Five that's come together to say that we want to see global convergence of reporting. I think that's great news. Enormous strides in terms of thinking about what is financially material. And we can come into some of this later. So there seems to be a consensus emerging that there are financially material pieces of information that should be disclosed that don't automatically crop up through your P&L and balance sheet. That seems to be a consensus area. Where there is a divergence between the UK and possibly with Europe is the extent to which companies should disclose beyond things that are financially material, the so-called double materiality. And what we see in Europe is a requirement to disclose double materiality. And the burden of that has been put largely on the investment industry. Using the demand-supply analogy that Eric mentioned, it's almost as if we ask the investors or tell the investors that they have to ask for this information, then corporates will have to respond. So it's quite curious that the power of the markets is being used to force a faster adaptation of corporate reporting. Now, this is backed by a lot of detailed technical work, primarily focused on green and climate, a so-called taxonomy. But we know, and you're one of the experts on this, Ida, so we should ask you as well, but we know that the social taxonomy side is going to pick up. So that's one theme. The other theme is a requirement, and this is really ambition both in the UK and in Europe, to meet the Paris Agreement on climate and to get to a net zero emissions by 2050. So the UK has come out with a very ambitious green plan, both for the country and for finance. So there's a green finance initiative as well as an economy initiative. And Europe has come out with probably the most demanding regulations that are affecting anybody that wants to sell any mutual fund into Europe, which is around the sustainable finance disclosure requirements. Now, those are really demanding. Now, you could argue that they're demanding about data rather than outcomes, but we can get into that as well. But it is all about information flow. And then the final thing I'll add, which is highly relevant in the UK, is that we have occupational pension schemes are equivalent to 401k, which we call defined contribution. And there is an increasing requirement on those schemes to report financial risks arising from climate change, and a consultation going on at the moment as to whether there should also be a reporting of factors that may be risk factors linked to social and employment ways of working within companies.
Thank you. Eric, are there any similarities? Is the US moving forward to meet the UK and Europe?
Most definitely, yes. Look, I think that when you talk about the United States, there are four things you need to keep in mind. First is, under President Biden, there's been a shift in just general US government policy to the acceptance of climate change and the need to do mitigation of climate change. Second is, an effort to show global leadership. I think you see in the G20 and the G7 kind of joining the Paris Agreement. This is a priority for the Biden administration, and it's probably its top priority, to be honest. Compared to a lot of other issues that traditionally have been kind of at the foremost of U.S. foreign policy. Third is this is across the board. We're here talking about sustainable finance, but even before we get to sustainable finance, we have to also see that this is going to affect everything from U.S. infrastructure investment, U.S. Environmental regulation. So sustainable finance is actually called one arrow in the quiver of what the U.S. is doing to fight climate change. And then fourth, when we do talk about sustainable finance, there's a very ambitious agenda that's centered around the SEC. It's not exclusively the SEC, but the SEC is definitely going to take a lead role with a new SEC chair, Gary Gensler, about to be confirmed in a few weeks. We can expect a very active agenda, which I think will try to closely match what's happening in the EU and the UK. Now, it will match in terms of the types of strategies. It may not match in terms of the substance of the strategies. And that's going to be a very important issue. I know we're going to get into this in more detail. But just really quickly, I think the things that the SEC are going to be doing will be mandatory disclosure, again, by corporate issuers, some type of support for an international standard along the lines of TCFD, SASB, or other standards, some greater regulation by investment funds and the disclosure of what funds themselves are doing, kind of a very strong cross-border element trying to work with EU, UK, and Asian authorities. And finally, the use of enforcement and examination tools to make sure that companies and funds today are already kind of shifting their direction. So it's a very kind of robust agenda, and I think it's going to be, for the next 2-3 years, very, very active in this space.
What about the pension fund area, or retirement plans as they're known in the US? There's ERISA, which is a statute. In the UK, you're relying more on the common law, and Europe does not have a tight statute like ERISA. Do you see retirement plans being as free as UK and EU vehicles to invest in ESG products?
So the answer is yes, but this is actually being driven by, again, the change in the administration. So in the last administration, the Department of Labor, which has responsibility for regulating ERISA and U.S. pension funds, actually passed regs that would have made it more difficult for pension funds to be invested in ESG funds. And the Biden administration has already announced that they will not enforce those regulations. So the regulations remain on the book. They're not going to be enforced. And this is clearly a signal that they want to open up the use of U.S. retirement savings for ESG investing.
I've heard from some that they're worried about private lawsuits. Is that still a threat? And if so, can we see a change coming in the rules? It would take a rulemaking, but might that happen?
Right. So I think, and this is a broader theme when we talk about anything regarding the U.S. and the EU, is it's a different litigation environment in the United States. Liability is quite different, and I think this is one of the complications for funds and companies trying to operate in multiple jurisdictions. The U.S. is unique in some cases, and so Ida, you're absolutely right. The potential for private litigation is always something that I think any market participant is very aware of. But at the same time, I think the signals from the administration shows that this is something that the administration wants to make it easier for retirement savings to be used in this space. I think it's premature to say that they're actually going to engage in new rulemaking. But I think that they're going to take a wait and see, and it would not surprise me if this is a personal prediction that if they find that there are deterrents, that maybe they will actually engage in rulemaking. But at this time, I don't think there's an appetite to do so.
And Elizabeth, if you were going to advise the Biden administration on what they might want to implement, taking some of the statutes and rules from Europe and the UK, what would be your top choices?
Oh, wow, what a gift. Well, I think let's stick with pensions for a minute, though, because I think there's something really fundamental about what you and Eric are talking about, which is these are long-term fiduciary duties towards people who are, who are going to outlive the trustees that are currently looking after them. The investments have to be long-term and sustainable. And I think, therefore, anything that one does in the pensions area has to be extremely well thought through and full support to the trustees and oversight committees that are responsible. I was a pension trustee for a while, and I would say, if you're going to do something, make sure that those officers who are responsible for enforcing it and following through are fully trained, supported, and have everything they need, because it's a big thing to ask. But I do think thinking about the ways in which capital is deployed for the longer term is absolutely front and center. And I would say that's whether it's for institutional investors or for retail investors. I think that's hugely important. What are the incentives that encourage long-term, responsible, and I don't mean responsible in an ethical sense, I mean genuinely responsible within a risk and return framework, use of capital. And I think that's something that does need thinking about very deeply. And secondly, accountability for the use of that capital. So the disclosures, I think there's a wider social license to operate expectation now among consumers. And it's not political. It's my money, tell me what you're doing with it. And that's democratization that I think companies would be very well advised to think about. So I would say think very strongly about long-term sustainable use of capital that generates growth, risk and return in the right proportion, and doesn't allow people to get rich quick at the future expense of generations yet to come, because that's just not going to do anybody any good. And then secondly, making sure that the disclosures are in a language that a consumer can understand. And I think that's a massive responsibility for every single lawyer, for every single general counsel and compliance person. I know what it's like when somebody says, just make this in plain English. The hair on the back of your neck stands up sometimes because you think, but I can't do that. But on the other hand, we have to find ways for people to understand where their money's going and for us to be accountable back to the population as to how we're using it. By the way, we could also go on about multi-stakeholder capitalism, but I think we focus on investment for the moment.
Okay. And Asia, what are the recent developments? Eric, is that one you could cover?
Sure. So Asia, in particular Japan, has been actually very open about supporting TCFD and SASB. So they're moving very strongly in the direction of corporate disclosure. But at the same time, I think from the Asian perspective, they know that a lot of the international kind of initiatives are coming from Europe, the UK, and the United States. They're active participants in these international discussions, but there's a bit of a wait and see. I think that Asia has, if I can generalize, I think the Asian markets would like to follow what is international market practice and international standards when it comes to ESG. And so if there's a consensus that develops between Europe and the US, then I think there'll be strong incentives by Asian authorities to try to incorporate whatever is that consensus into what they're doing in their jurisdictions.
And if I could just build on that, I think that's absolutely right. And the other thing I would add is on the reporting and disclosure side and global standards, obviously the IFRS development is absolutely key, and the Sustainable Standards Board. So if President Biden could put his weight behind that and accelerate it, I think this year, with America stepping into the multilateral discussions with an ambition for leadership that Eric described, it's hugely influential right now to think about what should the G7 pledge to, what should COP26 in November pledge to. And I think that could really accelerate an international coalescence around some things we can all agree with. And of course, in that mix, IOSCO it has a very important role to play and very well reflects the Asian needs and interests in that. So I think we're in a good path. I think one of the things we will and have to expect is there could be regional elements, because some regions will want to go faster or slower than others. But if we can get consensus on all the core elements and move towards that quickly under an international body, that would be a remarkable achievement in 2021.
And if I could just note on that, like, for example, IOSCO just today announced that they formed a new expert group. It's
Yeah.
co-chaired by the US SEC and the Monetary Authority of Singapore. So, it's example right there of Asia and the United States working together in support of the work with the IFRS Foundation.
Yeah.
But the other observation is, remember, the U.S. is a bit like a sports car starting from zero, and the European sports car has been running quite hot for a while. So even though I think there's strong political will in the U.S., especially with the new administration, there's a lot of the technical work that has to be done in the U.S. that hasn't that they're really just getting started now. And so I think there always will be for the near future a gap between the thinking in Europe and the UK versus in the United States.
Eric, I think, sorry,
sorry.
I was just going to say, I think this is where the ICI and your members can really play a role there, because many of your members are global asset managers who are already having to, parse through what's happening in different regions of the world. And I think the extent to which the good and the bad can be sifted out and what's realistic and practicable, this is where the ICI can really play a strong role within the United States to accelerate that, I'd have thought.
I think you must have broken into my email account, because that's definitely something that ICI is trying to do, because we do operate in many different jurisdictions. So I couldn't have said it better.
Yeah.
But the U.S. has never fully accepted IFRS and has a different accounting standard and system. How is that going to work?
Well, maybe if I could let me try to answer that first, which is, so while you're right that the U.S. has never fully embraced IFRS, the fact is that the SEC sits on the IFRS monitoring board and has been an active participant. It does allow IFRS to be used by foreign private issuers when they do SEC filings. So the SEC is not unfamiliar with the IFRS Foundation. But separately, I think that what the IFRS Foundation is thinking about doing in the case of kind of climate disclosure would be done in a new kind of body. And here, I think there's a real opportunity. If one looked at the history of accounting standards, the real issue was because the U.S. had embraced U.S. GAAP so firmly, that's very difficult for the U.S. to move over to IFRS. When we're talking about climate disclosure, it's an open field, and we're starting from ground zero. And I think there's a real opportunity for the SEC and the United States in general to get involved, be one of the founders, and therefore get quite comfortable with that structure.
Yeah, and SASB and even TCFD, if you think about where TCFD grew out of the work that Mark Carney did with Michael Bloomberg, I think there is a real opportunity, even though I never ever believe that the US is a sports car waiting to take off, I'm afraid, Eric. So I don't think you're at 0 miles an hour. I think there's a lot of smart people who are already planning and in the pits working it through. But I think there is a real opportunity. And I think, interestingly, it's almost the reverse challenge this time, Ida, which is the Europe is so far ahead and so wedded to what it's done. It's almost got the US challenge of US GAAP, which is how can we find the area of common agreement and then recognize that there will be different developments in different regions for very different reasons. And I think that's what we've got to try and work through. And we've got the knowledge of what we did and didn't get right with IFRS. We've got that knowledge, and I think we can use some of that experience.
On that note, there's something called the International Platform, which was originally founded by the EU, but now includes the UK, China, India. Eric, do you think, first, Elizabeth, it would be great for you to describe that a bit, but then I'm going to ask Eric whether he thinks the US might join.
Now, I think the International Platform is big in heart and big in hope. But my understanding, Ida, in terms of influence, is it's really a knowledge sharing platform, which I think is great because you can't start to form agreements until you're speaking the same language. So I think what it does is enable people to come together, look at what's happening and developing around these jurisdictions, get familiar with it, work out how it fits, doesn't fit, the fact that we could sometimes be violently agreeing but using different words to describe it. All of that can be developed in the platform. It's not a standards platform, is my understanding, though, unless you feel differently. I think it's almost pre that. It's like it's a proto stage before you could get into a standard setting framework.
But it seems like sort of a neutral ground where people.
That's exactly right. Because people can show up, share. There's no obligation when you walk away, and therefore it's very neutral. And it could be, the forming of relationships and mutual understandings. I'm sure it has some potential there.
Yeah, I know that the FCA believes that it's an opportunity to look at things like the taxonomy and find some way to harmonize. But Eric, do you think the U.S. might join?
So I think that goes to the heart of the issue, the word taxonomy, because to the extent that sustainability platform is focused on a taxonomy, I think it'll be quite challenging for the U.S. to be an active participant. And it has nothing to do with the global cooperation part. In fact, I think that is going to be the main attraction, is to join a body that seems to have a lot of like-minded authorities together. This is what we're already seeing in places like the G20 and the G7 again, and the Fed joining NGFS. But I think that there's concern about the idea of a common taxonomy. I would note when John Kerry was just in Paris, Bruno Le Maire raised it, and Kerry demurred in terms of supporting a common taxonomy. I think that there is called a regulatory philosophy difference in the U.S. I think the idea of a taxonomy which the official sector defines what is green or brown and transitional is something that I think the U.S. has not quite bought into that as a strategy. I think there's definitely much more support for kind of market-oriented approaches to figuring out what is sustainable, and so that's, I think, going to be part of the kind of hesitation to participate in the platform.
I would agree with that, and I think for the UK's almost got to join, because the UK has to navigate a way through post-Brexit. That means that we're not so divergent that we end up with radically different regulatory environments. But I think my sense is in the UK there's also a great belief that market forces, within the right sort of broad parameters, market forces can move faster and more effectively than people sitting in a room with a dictionary. And I think somehow the UK has got to navigate a way between those two things. On the one hand, the UK was very influential in Europe, as we know, Ida, in shaping many of the EU directives that we now have to decide how we respond to. On the other hand, there's always been a tension between capital markets and the way in which the UK and the US embrace capital markets, and the more dirigiste approach that some other jurisdictions can take. But there's something I wanted to ask Eric, which is around the US and Asia, because I think the US is also engaging very strongly with key jurisdictions in Asia, and I think that could be quite exciting as well.
So definitely, and of course, when we talk about Asia, we have to treat China separate from the rest of Asia, right? And so the U.S.-China story is incredibly interesting, because, of course, there are existing tensions between the two countries in many different areas, but climate is one area where there seems to be a real effort to try to be on the same page. It's U.S. and China who are co-chairing the G20 initiative. There's been summit meetings already in the area of climate. And so I think that that is going to be a very interesting thing to watch, is how the U.S. engages China. And I think it's the recognition is China, given the size of its economy, given I think the amount of pollution that comes from China, that getting China to be a partner is going to be critical to any global effort. And then separately, if you look at the other Asian jurisdictions, Japan, Singapore, Australia, I think there it's much more of, again, this line about, well, do we follow an EU taxonomy approach, or do we support a more market-oriented approach? I think my kind of read is the Asian jurisdictions would be very like-minded with the US and the UK in favoring a market-oriented approach, and that's something we'll have to watch in these international bodies, how that view is expressed.
And I think that does get us into the whole topic of multi-stakeholder capitalism, or however it's defined in different parts of the world, because if you take a market-based approach, I don't think it's going to be a sort of Chicago school market-based approach. It's going to be very much a 21st century reimagining of the role of capital in markets. And I think it's really interesting to see how that one's going to evolve, and the role that America chooses to play in shaping that. And I mean, Ida, you and I have worked in Europe for many, many years. Part of the resistance to a market-based approach would have been a concern for unbridled shareholder dominance of all other stakeholders. Whereas I think now, if you think about some of the discussions that are happening in boardrooms around the world, there is a real recognition that there are multiple stakeholders here, and we always have to be accountable for the use of capital and responsible financial disciplines. But there are many, many other stakeholders. And I can think in every single board meeting I've been in the boards I sit on, inclusion, equality, and diversity in the truest sense of there, as well as climate. And I think, interestingly, the work that SASB's doing, thinking around, what are the financially material factors around employment and supply chain, might actually slightly outpace where Europe gets to, because it will be a very pragmatic, data-driven approach as to what can companies report on. So I think this could be quite an interesting dynamic in the coming year.
Actually, Eric spent quite a bit of time in Europe as well when he was with the SEC and the CFTC. So he's familiar with that as well. So other bilateral developments, do you see anything happening between the US and the UK, or the EU and the US, or is it going to be more at the global level?
Well, I think anything you do globally has to be accompanied by strong bilateral conversations. And I think there's a recognition in the United States that the EU is the big player in the space. It's a big player not only because it's been thinking about this issue for a long time, but obviously the legislative initiatives and the fact that as some of these laws start entering into effect, they will have an extraterritorial impact. So our members at ICI, as Elizabeth pointed out, they're global players and they have European operations, and they're going to be subject to various EU rules. I think likewise, US-UK will be critical. UK and still very important global financial center. When we talk about sustainable finance, a lot of innovation, new products are going to be coming from the UK, and so what the UK does in this space will be critical. And then when we talk about kind of broader multilateral cooperation, there clearly will be some jockeying going on to find allies. And if there's an opportunity for the US and the UK to develop common positions, I think there's a feeling that would put both jurisdictions in a stronger position to then negotiate with the EU. So there's going to be kind of bilateral conversations with the multilateral conversations in mind.
Thanks
Totally
very
agree.
much.
Totally agree.
I have lots of questions stacking up, so I'm going to start with some of those from the audience. First one, what is your view on ESG ratings? They can confuse rather than inform. For instance, Boohoo was owned by ESG funds because of its rating, and BAT, despite being a tobacco company, scores highly. Who would like to take that one?
Shall I start? I mean, I think
Sure.
this is where if you try and shortcut the system, I think that it's going to really, really struggle. And I think, for me, a really good ESG investor starts with an understanding of why they care, what's their investment philosophy, what's their investment purpose, what do their clients want them to do, and it starts with that purpose and philosophy. And from that, they then define what matters to them. And from that, they then define the engagement strategy, the stewardship strategy, and the data required. Anybody that starts at the other end, which is these are the screens, these are the 5 screens, I'm going to take an average of the best for any stock, is always going to be challenged on precisely that matter, because ESG is multidimensional. And yeah, you can create jobs. Actually, we find out that Boohoo didn't create jobs. But you can create a situation where you're doubling down on one particular indicator. And I do think that that's why some people who think it's easy to integrate ESG are missing the point. This is particularly true if you haven't gone through that philosophical conversation with your portfolio managers. You can put a screen on to avoid risk. And that's just what's the market going to deem a risk? And there will be different points at different risks. That's the bit that's easy. But if you want to go beyond screening for risk into a material value creation driver over the medium term, you've got to have it linked to your investment philosophy. Even if you are a tracker, an ETF, or a passive fund of some sort, you've got to understand what your benchmark construction really means.
I fully agree with everything Elizabeth just said. And the only thing I would add on top of that is just to be concerned about trying to embed some of these ratings into regulatory requirements. I think that we've seen issues with credit ratings, and we've done that with regulation. We've seen it with various benchmarks when we do that, and I think that it's very seductive to kind of look at a rating and say, okay, so here's what apparently looks like an easy metric to determine whether one is ESG or not. But I think that as Elizabeth pointed out, ESG is complex, is multidimensional, and I think that we have to be very careful on our reliance on ratings.
I do think there might be more scrutiny on those ratings, because I think as you say, Eric, we learnt at our cost what happens with credit ratings if we sort of park our brain and just take the rating. If we see the same issue emerging for ESG, I think that could put us back. And you talk about litigation risk, and you talk about challenge to decisions made, whether it's by asset owners or asset managers. I think if people haven't really thought about those ratings, that is a source of future risk. And I do think there should be some more scrutiny around that and around benchmark construction. I think that would be a healthy development, market-based healthy development for the industry.
Thank you. So I'm going to go to another question. Do you foresee any political, legal, economic, and technological barriers in the complex process of moving towards sustainability and sustainable finance? An easy question.
Are we allowed just to say yes?
Who wants to start on that one?
Oh, Eric, why don't you kick off, because it's new territory to a degree in the US, and then I'll chip in with a few other thoughts.
Definitely. Well, I think first, I think Elizabeth's initial answer is right. It's yes across the board. I think there are definitely going to be challenges in all those spaces. So let me just take litigation and liability as an example, one place. So when we talk about disclosure by companies of their sustainability risk or ESG risk in general, which I think as a policy matter is probably the place where there's the most amount of consensus to start. Even in a place like that, there's questions like, well, to the extent that ESG risk cannot be quantified, or it's not necessarily 100% factual, that there's some qualitative assessments that need to be made, what is the liability that a company will face in terms of the accuracy of their disclosure? Here in the United States, liability for disclosure is a big deal. There's a legal difference between filing something with the SEC versus furnishing something with the SEC. And companies have to start thinking about those issues. We don't want to create a situation where the liability risk is so high that the disclosure becomes useless, or companies try to follow the most conservative approaches they can in an attempt to be defensive. Because that undermines, I think, the policy objective to try to encourage companies to be very forthcoming about their risks. At the same time, we don't want to remove any liability at all, because, of course, we do want there to be accurate information. So that's just one example of a very practical problem that needs to be figured out, and that's on one of the quote easier issues when we talk about the sustainable finance agenda.
Yeah, I think that's spot on. I think technology can be a barrier, but it can also be an enabler. And I think particularly in an era of the ability to crunch big data, to use alternative intelligence systems to work out information, I think the issue will be an overload of data and insufficient interrogation of it rather than the opposite. And technology has a role to play there. And I think just as you get conventions developed around financial disclosures and other disclosures, there will be conventions that get developed, which may not be a guarantee against litigation, but certainly in a sort of UK system, conventions and codes and practice do enable companies to move a little bit further forward in a less litigious way. And we could start to see some evolution and development there. I think the more we can start to see data repositories in common formats being used, the quicker you get to a situation where you've got substantive disclosures and less risks.
Okay, so a political question. U.S. Senator Pat Toomey, a Republican from Pennsylvania, recently criticized certain of the regional U.S. feds for their research into social and climate issues and warned against the making it political and getting U.S. central banks involved in politics. How would you respond to Senator Toomey?
Well, I think Senator Toomey is reflecting, you know, I think a substantial part of the U.S. political kind of system in terms of concern about sustainable finance, about the focus on ESG. So I do not question kind of Senator Toomey's kind of what he wrote to the regional feds, or actually more recently also the Attorney General of the state of West Virginia wrote a letter to the SEC about some comments that Acting Chair Allison Lee has said. And I think this goes to the nub of, you know, is the desire to look at climate and in S&G as part of ESG, is this political, or is it actually based upon real financial risk, real long-term value issues? And I think this is something that needs to be focused on. A big topic of discussion came up in Gary Gensler's testimony to the Senate during his confirmation hearings was, you know, what's materiality? And Gensler had said that, you know, the legal definition of materiality in the United States is, you know, information that a reasonable investor would want to know. So query is information about climate risk and the effect on the environment, or about human resources capital. Is this information that a reasonable investor would want to know? So I think that there is a valid debate happening in the United States about how much of this is being driven by political preferences versus how much of it's actually driven by the need to look at financial system risk and long-term value of companies.
Yeah, and I think, you know, there are many central banks who see this now, given that they have accepted much of the science that's come through, as financial system risk. And this is the question of what is the next systemic risk to the durability and resilience of the financial system. And certainly there's a lot of talk now about scenario evaluation. And I think if you think about how we responded to the global financial crisis, and you think about the capitalization and liquidity requirements that flowed through into the system after that, I think one way through this, and it doesn't answer that challenge, but one way is to start thinking about scenarios, what if scenarios, and to look at the extent to which lending, portfolios, assets, and other exposures are affected under different scenarios. And I suspect we'll see a lot more of that being required by prudential authorities around the world.
Okay, so I like this question. Will ESG become yet another tick box exercise for the industry?
I can give another short answer to that. Yes and no. I think there will be parts of the industry where it is a tick box, sadly. And the more we as an industry don't work together, and the more we inundate companies or others with thousands and thousands and thousands of uncoordinated questionnaires, the more it dissolves to the lowest common denominator of tick box. The no is, I think, actually for many, many investors and asset owners, this has gone beyond the point of whether it's relevant, whether it's material. It is of interest, and it is something that isn't going to go away. And I think there's an academic and intellectual curiosity that's been ignited around this, which is around, are these long-term predictors of value creation on a sustainable basis? So I think the academic work that's being done, the CFA Institute and others and all of that work, I think is really pushed it so that we're never going to go back to the way it was before. I think it's beholden to us not to make it tick box and to think about outcomes and real results. And that is tricky because we know that past performance isn't a guide to the future. And we know that no matter how brilliant our processes and our people are, we can't promise performance. But on the other hand, I think there will be a focus from regulators and from customers onto outcomes, which will drive it beyond a tick box. I really do believe that, but maybe I'm an optimist.
I think it's a good question.
Eric, but I think it'll be across the whole distribution of that, from people who will do one through to the other. But we have an industry responsibility, don't you think, Eric, to really drive this and to set the pace of what good should look like?
I definitely agree, but I also just want to say that whether or not it turns out to be a tick the box exercise also depends on how the regulators write the rules.
Very good point.
I think
point.
We've had experience in the past in other areas of American securities law, like Sarbanes-Oxley, where sometimes you become a tick the box exercise because you have a very prescriptive rule that kind of puts the issuer or the market participant in a certain position where they have to say yes or no. And I think that we have an opportunity here to write a more principles-based approach that actually, encourages companies, incentivizes them to provide more fulsome information and move away from tick the box. And then Elizabeth is right. Also, when we talk about the industry, especially the investment funds industry, as those who are looking at companies and what they provide in order to make investment decisions, we have to also demand companies to provide meaningful disclosure, so-called decision useful information. And you're not going to get that from a tick the box type of disclosure form.
Well, this has been a great discussion. We only have 3 minutes left. I hesitate to take on another question. We're not going to get to all of them. Thank you so much. Do you have parting words? Just a quick comment on sustainable finance to close out the hour. Do you want to start?
Something? Yeah, I mean, I think we're in such an exciting period. I really, really do. I mean, there's huge capital in motion. We can see that. We can see the system is starting to shift, and investment managers are absolutely at the fulcrum of helping that along. And I think probably we underestimate the responsibility, but also the potential power of doing that. And I think taking that forward and the idea that we can work with the United States, with Europe, the UK working together, and with Asia, I think is really exciting. But we need the mechanisms to encourage that collaboration and dialogue to continue. But it's never been a more lucrative time to really think about this.
And all I'd like to add is I think what's also exciting about this opportunity is that this is not something that's going to happen in the closed doors of some government office building. It's really going to require the involvement of industry, regulators, stakeholders, NGOs, scientists. This is truly a multidisciplinary problem that needs to be addressed. And I think that's actually quite exciting. When we think about if I can be a little bit philosophical, we think about policymaking and regulation as really a public process. This is truly going to be a public process. And so to the people listening to today's webinar and to the groups that people work for, I think this is going to be a really exciting regulatory area. And it's going to take everyone's hard work to make it happen.